Meantime, the Fed kicking off its latest two-day policy meeting today. The central bank not expected to make any moves, but it's undoubtedly paying some attention to interest rates, as are investors. Check out Treasury yields this morning. Let's show you where things stand. The 10-year note, we're going to show you a board right now, if we could. 10-year note at 1.625. Join us right now to talk rates and how investors are dealing with the sharp moves we've seen in the last few days is Kathy Jones, Chief Fixed Income Strategist at the Schwab, I think of Charles Schwab, but the Schwab Center for Financial Research, along with our own Mike Santoli, Senior Markets Commentator. What do you make of what's happened here? We teased this and we said it's been on such a, I mean, it's not a roller coaster. It's just a straight down line.
Yeah, you know, we were coming into the year. The idea was a little bit of economic momentum picking up in Europe, China stabilizing, and the U.S. economy continuing to chug along. So the idea was that rates would probably drift a little bit higher, Fed on hold, steeper yield curve, and then the virus hit. And now it dampens expectations for global growth. It raises just a lot of uncertainty, and we're seeing rates respond to that.
Overdone? Underdone?
Well,
that's the question, right?
Yeah, if I knew a lot about the coronavirus and I could weigh in on what was going to happen with it, I would have a better answer for you. But I think for the moment, it's a reasonable expectation that, you know, if you lock down millions and millions of people in China and you disrupt supply chains, you're going to get slower growth. So that's what the market's responding to. I think we'll probably see 10-year yields hold, you know, above the 1.5% level, because below that you'd be discounting probably a global recession or a significantly more Fed easing.
What are you thinking, Mike?
I mean, part of what it reflects is the fact that inflation and inflation expectations have taken another slide. The Fed has already told you the bar is pretty high here in terms of doing anything, but the leaning is in the direction potentially of easing if they're not making their inflation target. So the market is responding in part to that, as well as the fact that this global acceleration of growth has not happened on time, so to speak. The market's got positioned for it at the start of the year, and now it looks like at best it's going to get pushed off a little bit just because of what's going on in Asia. So that makes sense. What I've been more watching perhaps is the credit markets, not just the Treasury markets, because that's been an amazingly strong story. That they've been corporate bond yields have been very compressed. Now they've kind of softened up a little bit, and so you're starting to see a little bit of the typical concern of an over-optimistic market just having a little bit of a head check in terms of whether they got a little too far ahead of themselves.
What do you think the downside risk is at this point?
Well, for the stock market,
yeah.
We're 2.5% off the highs. This looks like it's going to be a little bit of a bounce attempt right here. I think that if all it was just, hey, sentiment and valuation got a little bit stretched in the short term, and we got a little too overexcited about the big NASDAQ stocks, then 2 to 5% downside from the highs is probably enough to skim that away if you don't have, again, a downside surprise in terms of growth trajectory, which in the U.S. it doesn't really
look like. What do you think,
happening.
to the extent that you're looking at the bond market or even equities, what do you think the market is expecting in terms of the coronavirus, in terms of how long this lasts? What's baked in? When you talk to different analysts, when you talk to different people, what are they thinking?
Well, I think one of the dynamics...
About the depths of this.
Yeah, one of the dynamics in the bond market that Mike was alluding to is that credit spreads were incredibly tight. You look at high yield, the yields were very low, almost record low levels. And part of that was the expectation that growth would continue with very easy monetary policy. So we've got the easy monetary policy, but the growth prospects, especially for commodities now, has shifted because global demand could be down. So you're saying widening of the credit spreads, about 12% of the high yield market is energy related, and they've really gotten hit. So I think what the market is saying, this could last a while. I can't put a 6 months, 3 months, 6 months, but a couple of quarters of very slow growth.
I don't think I agree. The bond market looks like it's hunkering down for that kind of thing. The stock market, I think, is assuming it's going to be more or less contained.
Right.
And we're going to get to a point where we go from this is the headwind to the first quarter results and global growth and a lot of these globally exposed companies to, if it's contained in 2 months, it all of a sudden becomes a mulligan. And it's like the reason you get a pass on last quarter's bad numbers. So I think the stock market's looking at it a little more like we don't really in a sustained way have to worry about this.
Okay.